Welcome to MacroPulse Business. Today is May 15, 2026, and we are witnessing historic movements in the global economy. The United States stock market has reached unprecedented levels, with the Dow Jones Industrial Average retaking the 50,000 mark and the S&P 500 surging to a new all-time high of 7,472. This remarkable rally is being driven by a powerful resurgence in artificial intelligence investments and stronger-than-expected corporate earnings. In the first quarter, S&P 500 companies reported a blended earnings growth rate of 15.1%, with profit margins reaching a record 13.4%. The market is pricing in continued economic resilience, despite significant geopolitical headwinds. Let us take a deeper look at the forces driving this extraordinary market rally. The artificial intelligence trade has roared back with remarkable intensity. NVIDIA shares climbed 3% on Wednesday alone, after Reuters reported that the chipmaker is expanding its data center partnerships across Asia. Alphabet, Google's parent company, has surged an astonishing 34% in April, fueled by strong cloud computing revenue and its Gemini AI platform. Meanwhile, Cerebras Systems, a leading AI chip startup, is expected to begin trading at $350 per share, representing an 89% premium over its initial offering price. The forward price-to-earnings ratio of the S&P 500 now stands at 20.9 times, above both the 5-year average of 19.9 and the 10-year average of 18.9, raising questions about whether valuations have become stretched. A major catalyst for today's market optimism is the ongoing trade summit in Beijing. President Donald Trump is currently meeting with Chinese President Xi Jinping, marking the first United States presidential visit to China since 2017. The three-day summit has already yielded significant diplomatic progress. According to reports, both leaders have agreed that the Strait of Hormuz must remain a free waterway, pushing back against Iranian attempts to impose payments on shipping traffic. Treasury Secretary Scott Bessent indicated that China will use its considerable influence with Iran to help reopen the strait. This rare moment of bilateral cooperation between the world's two largest economies has provided a massive boost to investor confidence. However, the global economy continues to grapple with the severe energy shock triggered by the ongoing conflict with Iran. Brent crude oil is currently trading around $105 per barrel. While this is down from the peak of $120 seen in April, it remains significantly higher than the pre-war level of roughly $70. The International Energy Agency reports that supply losses from Gulf producers have exceeded 1 billion barrels. Furthermore, the agency projects a global oil demand contraction of 1.5 million barrels per day in the second quarter, warning that the market will remain undersupplied through the third quarter of 2026, even if the conflict ends immediately. The Strait of Hormuz remains at the center of the global energy crisis. Approximately 1/5 of the world's oil and gas passes through this narrow waterway, making it arguably the most strategically important choke point in global trade. The United States naval blockade of Iranian ports has been extended indefinitely, while Iran has attempted to impose transit fees on vessels passing through the strait. Recent reports indicate that some vessels are now crossing the strait, suggesting a partial easing of tensions. However, oil analysts warn that the situation remains highly volatile. Morgan Stanley strategists have noted that oil prices are lower relative to other historical supply shocks, thanks to two global forces working in tandem: increased U.S. oil exports and China's strategic petroleum imports. This dual buffer has prevented prices from reaching the catastrophic levels some had feared. Despite these energy pressures, the United States economy has demonstrated remarkable resilience. First quarter gross domestic product grew at an annualized rate of 2%, a significant acceleration from the 0.5% recorded in the fourth quarter of 2025, which was heavily impacted by a 43-day government shutdown. The labor market also remains stable, with employers adding 178,000 jobs in March and the unemployment rate holding at 4.3%. Retail sales climbed 0.5% in April, though economists note that consumers are spending more on higher-priced gasoline while cutting back on durable goods. The underlying strength of the U.S. consumer continues to defy expectations of a broader slowdown. Yet, This resilience comes with a significant cost: persistent inflation. Kansas City Federal Reserve President Jeffrey Schmid recently warned that inflation remains the most pressing risk to the U.S. economy. The Consumer Price Index accelerated to 3.3% year-over-year in March, driven largely by a 21.2% surge in gasoline prices. Furthermore, U.S. export prices rose 8.8% over the past 12 months, the largest advance in years. The Institute for Supply Management's Manufacturing Prices Index has also reached its highest level since April 2022. The energy shock is clearly passing through to the broader economy, complicating the path forward for monetary policy. This complex economic environment is the inheritance of the new Federal Reserve Chairman. The United States Senate has officially confirmed Kevin Warsh as the new head of the central bank, succeeding Jerome Powell, whose term as chair ends today, May 15th. Warsh takes the helm at a critical juncture. The Federal Reserve recently held its benchmark interest rate steady at a range of 3.50 to 3.75%. Notably, the April meeting saw 4 dissenting votes, the most since 1992, with 3 regional presidents pushing for a more hawkish stance due to the re-acceleration of inflation. Warsh will have to navigate a deeply divided committee while managing the dual mandate of price stability and maximum employment. The combination of an oil shock, rising inflation, and slowing global growth has inevitably drawn comparisons to the stagflation of the 1970s. However, leading economists point out crucial differences. The most significant structural change is that the oil intensity of the U.S. gross domestic product has declined by more than 50% since 1973. This means an identical oil price shock today produces a meaningfully smaller drag on economic output. Additionally, long-term inflation expectations remain anchored near the Federal Reserve's 2% target, unlike the unmoored expectations of the 1970s. However, policymakers today face a different constraint. The U.S. national debt now stands at $39 trillion, severely limiting fiscal flexibility. Turning to Europe, the economic picture is more strained. The European Union's business investment rate has plunged to 21.8%, its lowest level in more than a decade. Eurostat data indicates that tariffs, weak demand, and climate policy confusion are dragging down corporate spending. However, there are bright spots. The United Kingdom economy expanded by 0.6% in the first quarter, in line with expectations, led by broad-based increases across the services sector. Furthermore, the Pan-European Stocks 600 index has shown resilience, supported by robust corporate earnings, as investors seek out undiscovered value in European equities amidst easing geopolitical tensions. The European Central Bank is facing its own inflation battle. The ECB recently left its benchmark interest rate unchanged at 2% for its 7th consecutive meeting, citing the Middle East conflict's impact on energy prices. However, the consensus is shifting rapidly. Markets now expect the European Central Bank to hike its deposit rate next month, and at least once more this year, to combat the war-led inflation spike. A recent Bloomberg survey confirmed that economists anticipate 2 rate hikes from the ECB in 2026. This hawkish outlook has helped the euro hold its gains against other major currencies, as the central bank prioritizes price stability over stimulating sluggish growth. In Asia, Japan's economy is showing signs of a solid recovery. According to average estimates by 10 private think tanks, the Japanese economy is projected to have grown at an annualized pace of 1.8% in the first quarter of 2026. This marks the 2nd consecutive quarter of expansion. The growth is being driven by a 1.2% expansion in exports, fueled by a recovery in automobile shipments to the United States and strong global demand for semiconductors. Personal consumption also rose by 0.2%. Analysts note that the effective closure of the Strait of Hormuz had little impact on Japan in the first quarter, as vessels had already passed through before the disruption began. This economic recovery is prompting a shift at the Bank of Japan. The central bank kept its policy rate steady at 0.75% last month, but 3 of the 9 board members dissented, calling for an immediate hike to 1%. Now, BOJ board member Kazuyuki Misu has publicly called for the central bank to raise interest rates at the earliest stage possible, assuming there are no clear signs of an economic slowdown. With Japan's real wages rising in March and inflation approaching the 2% target, markets are increasingly pricing in a rate hike at the BOJ's next meeting in June. The OECD even projects the Bank of Japan will raise its overnight rate to 2% by the end of 2027. Japan's government is also taking proactive fiscal measures to shield its economy from the energy shock. Prime Minister Sanai Takaichi's administration is considering an extra budget of approximately 1 trillion yen, equivalent to roughly $6.34 billion, specifically to address rising fuel bills for households and businesses. This comes on top of existing measures, including the abolition of provisional gasoline tax surcharges and government subsidies for electricity and city gas. Japanese exports have been a particular bright spot, with automobile shipments to the United States recovering strongly after the impact of President Trump's tariffs waned earlier in the year. The semiconductor sector continues to be a major growth driver, as global demand for advanced chips shows no signs of slowing down. These factors combined paint a cautiously optimistic picture for the Japanese economy heading into the second half of 2026. As we look ahead, the global economy is entering an unprecedented phase of monetary policy convergence. The Federal Reserve, the European Central Bank, and the Bank of Japan are all facing intense inflationary pressures driven by the global energy shock. We may witness a rare scenario where all three major central banks are forced to maintain or raise interest rates simultaneously. Yet, despite these headwinds, corporate earnings remain robust, and equity markets continue to set new records. The key to navigating the remainder of 2026 will be monitoring the diplomatic efforts in Beijing, the resolution of the Strait of Hormuz crisis, and the delicate balancing act of central bankers worldwide. Thank you for watching MacroPulse Business.